Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's top stories with you. We're starting off with some big news from the Indian market. The Securities and Exchange Board of India, or SEBI, has granted an extension to National Securities Depository Ltd, or NSDL, to launch its initial public offering, or IPO, until July 31st, 2025. This is a significant development, as NSDL is one of the largest depositories in India, holding over Rs 500 lakh crore, or USD 6 trillion, in assets. The proposed IPO will be a complete offer for sale, where existing shareholders, including the National Stock Exchange of India, State Bank of India, and HDFC Bank, will sell their shares to the public. This move is expected to help NSDL comply with SEBI's ownership norms, which require that no entity can hold more than 15% of the shareholding in a depository company. But what does this mean for investors? Will this IPO be a good opportunity to get in on the ground floor of a major player in the Indian financial market? We'll be exploring these questions and more in the coming segments. In other news, the global market is watching with bated breath as U.S. President Donald Trump's trade policies continue to shape the economic landscape. The recent tariffs imposed on certain goods have led to a significant increase in trade tensions between the U.S. and its trading partners. How will this impact the Indian market, and what can investors expect in the coming months? We'll also be taking a closer look at the recent volatility in the stock market and what it means for your investments. From the impact of global events on the Sensex to the latest trends in the IPO market, we'll be covering it all. So, stay tuned for more analysis, insights, and expert opinions on the world of stocks and finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of global trade and economics. Our middle segment today takes a closer look at the escalating tensions between the US and the EU over tariffs and trade policies. Now, let's get straight into it. The US has been imposing tariffs on various countries, including China and the EU, in an effort to reduce its trade deficit and reindustrialize its economy. However, this move has not been without consequences, with many experts warning of a potential trade war that could have far-reaching impacts on global markets. The EU in particular has been singled out by the US, with President Trump targeting countries like Germany, Italy, and Ireland for their significant trade surpluses with the US. The EU has responded by imposing its own tariffs on US goods, leading to a tit-for-tat situation that's causing concern among investors and businesses. According to data, the U.S. is the largest importer of goods in the world, buying over $3 trillion worth of products in 2023. Its largest trade deficit is with China, followed closely by the EU, which has a trade surplus of $208 billion. Germany, Ireland, and Italy are among the top EU countries enjoying a surplus in goods trade with the U.S. But what does this mean for businesses and investors? Well, the U.S. markets have been spooked, with the S&P 500 and NASDAQ closing March trade with their worst quarter performance since Russia's invasion of Ukraine in 2022. On the other hand, the EU is presenting itself as a safe haven, with the Pan-European Stocks 600 index gaining 6.4% so far this year. It's a complex situation, and one that requires careful consideration of all perspectives. While some argue that tariffs can help protect domestic industries and jobs, others claim they can lead to higher prices for consumers and reduced economic growth. As we continue to monitor the situation, it's clear that the US-EU trade tensions are far from over. The EU is delaying countermeasures in hopes of opening a space for talks, while the US remains committed to its tariff policies. That's all for this segment of the Riskwiser Zone. We'll be keeping a close eye on developments and bringing you updates as more information becomes available. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've got a thrilling closing segment for you today, folks. As we wrap up our discussion on global trade and economic trends, let's dive into the latest news on tariffs and their potential impact on the market. We've been following the developments in the U.S., where President Trump has announced plans to introduce new tariffs, dubbed Liberation Day by the White House. The details are still sketchy, but it's clear that this move could have far-reaching consequences for businesses and investors around the world. Now, let's break it down. The proposed tariffs could apply to all countries, with some speculation suggesting rates as high as 25% on certain goods. This has sparked concerns among European officials, who are preparing for a potential double-digit tariff on their exports. Meanwhile, other countries like Canada and Mexico are also bracing themselves for the impact. The question on everyone's mind is, who will pay the price? Technically, U.S. firms importing goods will face the bill, but it's likely that these costs will be passed on to consumers through higher prices. This raises the risk of an economic recession, not just in the U.S., but also globally, as many businesses rely on American sales. It's essential to note that the situation is complex, and the repercussions of these tariffs will be difficult to predict. While some companies may try to offset costs by changing suppliers or sharing the burden with business partners, others may simply raise prices, which could lead to decreased demand. As investors, it's crucial to stay informed and adapt to these changes. We recommend keeping a close eye on market trends and adjusting your portfolios accordingly. Remember, diversification is key to managing risk in uncertain times. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.